We're now joined by Ajay Bagga, market expert. Thank you very much, Mr. Bagga, for joining us on India Tonight. Now, the study, interestingly, of course, comes in just a day after tax increases were seen on equity trading. And there have been a set of regulatory warnings that have been given out as far as, the F&O segment and the risks that are concerned. But beyond warnings, what kind of reforms can be ushered in by market regulator, Mr. Bagga?
Yeah, traditionally we used to always tell investors at investor camps, that if you have three things, then get into direct equities: time, training, and temperament. What happened in the COVID period? There was a gamification. The trading became a video game. You got access through online brokerages, and the cost of access with a zero brokerage, without realizing the STT, the GST in terms of IGST, the exchange, charges, the government charges, the stamp duty, all those, if you add in, it was a hefty sum as well. So this report talks about how 19% is the cost of, the charges to profitable customers. Leave aside non-profitable, though are anyways finished. Most of these investors don't have time, training, or temperament. What can the government do? Access is there. It's very easy. It is a symmetric information market where you can get online and get all kinds of charts and technical software, and you have workshops. The government needs to put their market intermediaries, be it the brokers or the exchanges, into an investor education initiative. Some part of their revenues, not even profits, part of their revenues should go into massive public awareness, investor education. Second, you have to put some stumbling blocks of entry to customers. So I don't know whether certification will work, because someone else can trade on behalf, given it's online and it's anonymized. But maybe some amount of certification. Third, maybe some net worth requirement for coming into trading. That could be one, barrier to create. And, so that people stop seeing it as a video game and understand it's their hard-earned money, which is flying away with every time that they are trading.
Right. Right, Mr. Bagga, and I was just speaking about, the tax increases on equity trading. LTCG and STCG were hiked, and of course the markets reacted quite decently to it. But the big question is there more action that is expected from the government, considering that not just the SEBI chief, but the CA, Chief Economic Advisor, has also spoken about, market needing reforms, and of course how young investors are really sometimes facing the brunt of over-enthusiasm and optimism in the markets.
You can only educate. If you create too many barriers, then the free market goes. I'll give you an example. China recently has banned short selling. The Chinese market is still falling. On an $8 trillion market, now the short positions are 3.8 billion. So they have eliminated the short selling, but then it becomes a market of excess, and it becomes a very shallow market. So these retail players do have a role to play. But I would say, through education, what we would tell investors: start with an index fund, then get into an actively managed fund, analyze their portfolios, understand the markets, then start with a small amount. And if you have training and if you have time, only then get in. Temperament comes with experience that no one gets, no one is born with it. So, 9 out of 10 losing money in F&O, 7 out of 10 in the cash markets is a very scary number, but it's not surprising. That is the global trend as well. All the Robin Hooders have lost money like this, and most of them then leave. In 1990s, there was an L.C. Gupta committee which had put out these numbers that unfortunately the young investors come directly into the markets, they lose everything, and then they become bank deposit holders for the rest of their lives.
Right, right. Absolutely, Mr. Bagga. Mr. Bagga, we're a little short of time, so I'll ask you to weigh in on the over-financialization of the markets aspect. I mean, several experts have also stated that over-financialization of the markets could seem great at this moment, considering that there is a bull run, but in markets elsewhere, that has led to the detriment of the economy. If you could weigh in on that point as well.
Yeah, especially if it's government debt and over leverage, over financialization hurts. But in a growing economy like India, we have to see what China did over the last 30, 35 years. We don't have to create barriers to this over financialization. It's a global phenomena. It is very true. US, if you look at their GDP and look at the US market, it's like 200%. So a 50, $55 trillion stock market in the US versus a $25 trillion GDP. We are at 1.4, so that is scary. It should not be higher than 100 times, 100%. But uh, given that we are such a high growth economy, we need that financialization to create capital. We are a capital deficient country. So I would not be so worried within India about it. I would be worried on the leverage actors. So if F&O players and anybody taking unbounded leverage, and that comes home to roost, that's the risk. So what the RBI has done very nicely, keeping the banks out of it, that's good. SEBI is trying to bring in measures, those are good. So regulator can do only that much, but financialization is a mega trend here to stay.
Financialization is a mega trend, and that's here to stay. Thank you very much, Mr. Bagga. You're saying that there should not be multiple barriers as far as the markets are concerned. However, investor education is critical so far as safeguarding their interests are concerned. On that note, once again, Mr. Bagga, thanks very much for taking the time out and speaking with us.
If you like this video, then like, share and subscribe to ET Now.